The Kenyan banking industry has been on a roll this year following the near collapse of Chase Bank due to what the Central Bank of Kenya terms as Kenya's biggest insider lending scandal. The banks have also been misrepresenting their portfolio of non-performing loans, with the regulator forcing them to reclassify their loans. To bring sanity into the sector, the banks will now have to adhere with new requirements developed by the Central Bank of Kenya.
There are guidelines. The guidelines are there. The issue has always been implementation of the guidelines. So the guidelines are 20%, I believe it is, of capital. But it's one thing to have it at 20 and another to have a bank that has lent 40%. I mean, that's a whole different bag of tricks.
CBK Governor Dr. Patrick Njoroge says bank will now be required to furnish the regulator with details of credit advanced to the management as well as directors. As at last month, the level of bad loans in the banking sector had hit a 10-year high of 8.2%, pointing to a serious distress amongst borrowers. The governor has blamed these on high lending rates.
From my own looking at some of these numbers, when you get 10%, these generally 10% spreads, they generally happen in countries that have gone through a substantial shock in their financial sector. So a collapse and things like that. So Kenya is different in that regard, but I'm just saying that the spreads are quite large. And this is the point that we've been making.
Njoroge has also directed banks to review downward their interest spread to suppress the portfolio of non-performing loans. The governor projects the Kenyan economy to expand by 6%, up from 5.6% growth recorded last year, supported by stronger agriculture performance, macroeconomic stability, as well as recovering tourism industry.